Hi guys, Stanley here. I'm the co-founder of valueinvestation.com, an investment portal where we'll give you investment news and in-depth analysis on listed company every single week. If you're new to this channel, remember to hit that subscribe button so you'll not miss out on any of our future videos. In our previous video, we talked about the 10 key reasons why you should consider investing in Singapore REITs. We also talk about the 5 key types of S-REIT in another video. So if you have missed out on any of those videos, remember to check them out first. But today, it's time for us to discuss how we can access the strength of a REIT. And number one, we should look at the property portfolio. When it comes to property, we often hear the cliche of location, location, location. It's still true when we're looking at a REIT. After all, a REIT needs to seek out tenants to secure a consistent stream of rental income. If the REIT owns properties that are easily accessible, well-equipped, and well-maintained of high quality, then they have a higher chance of attracting good tenants. High-quality properties also encourage tenants to renew their leases and stay on, rather than seeking out alternatives. So the location and the condition of a property will impact the tenancy retention rate and also occupancy rate. Number two, a reputable sponsor. A reputable sponsor is another important factor for us to look at. This is because the sponsor provides a strong pipeline of future properties that could be injected into the REIT. The sponsor pipeline represents an opportunity for the REIT to acquire more properties and to grow its portfolio. With each acquisition, it could add the potential of growing the overall value of the REIT for investors, instead of just relying on the rental income. Moreover, a good and strong sponsor can also add to the funding stability of a REIT. So reputable sponsors with deep pocket includes Capital Land Investment Limited, Fraser Property Limited, and also Mapletree Investment Private Limited. Thus, there is no surprise that most of their REITs tends to trade at a premium compared to many of their smaller independent REITs. Number 3, track record of rising distribution. Income investors want REITs with reliable income. Therefore, we want to find REITs with a long history of paying a consistent distribution per unit. Even better is when we can find REITs with growing distribution over time. But we should be careful and check if a REIT is artificially inflating its distribution through things like rental support or not spending enough capex to maintain a property. Number 4, tenant profile. Another area to consider is the REIT's tenant profile. After all, a REIT's income is dependent on the ability of the tenant to keep paying its rental. Investors will have more confidence in a REIT with large number of reputable tenants. These tenants are more likely to service the rent even if a major crisis breaks out. Also, a REIT with a diversified tenant list from different sectors will have a lower risk as well. The REIT will not be impacted if any particular sector is facing a slowdown. For example, we saw in this COVID-19 pandemic how it impacted the tourism sector. So for hospitality REIT that are only focused on the tourism sector, it could fall into a deep crisis. We want to find REIT with low reliance on any one tenant. And this is because if anything happened to that anchor tenants, the REIT could fall into financial difficulty as well. Number 5, property yield and price to book. Property yield is the amount of net property income from a property in comparison to its property value. The higher the property yield, generally is better. But we should be careful when making comparison. Ideally, you need to compare REITs within the same sector. For example, you want to compare the property yield of industrial REITs like Ascendas REIT with other industrial REITs like maybe Mapletree Industrial REIT and not REIT from the retail sector. This is because property across different sectors might have very different yield. Another matrix to consider is the price to book ratio. This compares the REIT's unit price to its net asset value per unit. Theoretically, a price to book greater than 1 means that investors are valuing the REIT more than all its net asset combined. However, as an investor, we should not really rely on the simple interpretation of price to book ratio. Some REIT might trade above or below its book value for an extended period of time. And this might be due to either the quality of the manager or other factors like having strong or weak sponsors. Gearing ratio and cost of financing. The financial strength of a REIT is also very important here. We can observe that through gearing ratio, the cost of financing, and also interest coverage ratio. For leverage, the regulators have set a limit of 50% for all REITs in Singapore. And most REIT maintain their gearing ratio between 30 to 40%, allowing sufficient buffer in case they need to borrow more for acquisition. So it is better to find REIT with a low and safe gearing ratio compared to one with a high ratio. Apart from that, we should also take note of the cost of financing. A higher cost of financing implies that more cash is needed to service the debt, therefore leaving less for distribution. All else being equal, a REIT with a lower cost of borrowing is favored over one with a higher cost. And the third aspect for investors to watch is the interest coverage ratio. This represents how well the REIT can service its debt. A higher interest coverage ratio is preferred as it means that the REIT has more income to service its loan. Number 7, growth. Next, we need to assess the REIT's growth strategy. There are 3 main methods that a REIT can possibly increase its asset under management and distribution. They can do it through acquisition, rental increase, or asset enhancement initiative. Acquisition will immediately increase the number of portfolio within a REIT and bump up its asset under management. Sometimes if the REIT acquire a property with good yield, it can also increase the distribution per unit for investors. We can review a REIT's acquisition history by seeing if it has been active in acquisition and also if those acquisition has increased distribution per unit over time. The REIT can also grow through just increasing its rental, and this is beneficial for the REIT as it allows it to increase its income without relying more on acquisition. However, there is always a limit to how much the REIT can increase its rents before chasing a tenant away. So the REIT needs to manage this very carefully. The third initiative is what we call asset enhancement initiative. This is when the REIT can spend some capex to upgrade, refurbish, or renovate a property. This enhancement work can either improve the accessibility or the attractiveness of a property, thus enticing more tenants. It may also improve the gross floor area of the property so that it can increase its net lettable area. Overall, the objective is always to raise the value of the property and attract better rental. If all these measures are successful, they will bring in higher level of rental income for the REIT, which in turn improve yield for investors. So there you have it. What else will you look for in a REIT? Let us know in the comments below. And if you have gotten value from this video, please give us a like and share it with a friend who you might think will also benefit from it as well. And if you are new to investing and ready to take the next step, you can always check out our free investing course at valueinvestasia.com/free course. As always, my name is Stanley. Till we meet again, invest safely.